Subscribe to our channel and click on the bell button to receive important financial updates faster than anybody else. Welcome to another video on your channel Profit and Equities. In this video, we'll be talking about a tiny specialty chemical small cap which could be a huge wealth creator going forward. Now friends, if you are benefited by the content that we produce on our channel, please don't forget to like this video, share these videos, and if you have not already subscribed to this channel, please click on the red subscribe button and choose all notifications in order to be notified whenever we upload a new video. Please watch this video to know more about this stock. Now the company in question is SEA Industries Limited, which is available at Rs 409.25 and the face value for it is 10. The symbol for it is SEYAIND. Now SEA Industries Limited is an India-based company which is engaged in the business of dichlorobenzidines and nitroanilines. The company is engaged in manufacturing and exporting of pigment, pharmaceuticals, agrochemicals, and rubber chemical intermediates. Now, while this benzene player's capacity utilization is near optimum for the existing business, near to medium term volume growth will be decided mainly by its greenfield capacity expansion program. This has neared 80% completion. The vertically integrated operations and a strategy to focus on products with high import intensity have led to elevated operating margins. The company is likely to defend a sustainable operating margin of 25% plus over the long term, even if China's earlier closed capacities are revived. Outlook on this stock is positive given its valuation discount to its peers in the benzene derivatives space. Taking into account the mega capex project and the lower end of the management's guidance, the source for this video estimates revenue CAGR of 36% over the next 4 years. Having said that, key profitability metric EBITDA per ton may moderate due to product mix and normalization in Chinese production disruptions, partially offset by vertical integration benefits. Already at the sales level, we are witnessing moderation in realization due to the China factor. Taking a conservative assumption, operating margin may drop to 30% in the near term. The stock is currently trading at 10.6 times and 7.3 times its FY20 and FY21 earnings respectively. There is a belief that the current valuations are at substantial discount to peers and offer investors an interesting opportunity for accumulation. Now looking at the financials, the company is a tiny small cap with a market capitalization of 1006.76 crores. The EPS of 38.89 translates into a price to earnings ratio of 10.52, which is dirt cheap when compared with the industry price to earnings ratio of 29.37. The price to book ratio of 1.08 is also not wildly expensive. Now the promoter's holding is also a strong factor at 74.53%. However, 14.51% of the promoter's holding is pledged. Now friends, this is not our own research. We'll be providing a link to the source for this video in the description section. Please go through it to build more conviction around your investment decision. Thanks for watching, and if you have not already subscribed to this channel, please consider doing so.